thank you all for joining and welcome to this Chartered Institute of Bankers Ghana Thought Leadership event. We can start with a word of prayer. So let's pray. Father, we thank you and bless you. We ask for your grace, even as you have given us life this morning. We pray for our country and we pray for the financial sector of this economy. We are grateful for all those who have joined us, and we thank you for our panel members. Thank you, because we know that this event will be successful. Even in advance, we thank you. Amen. So thank you all once again for joining us. I would invite the Chartered Institute of Bankers Ghana President, Mr. Benjamin Amenume, to make some quick opening remarks, and we can roll from there. Thank you. Mr. President, if you can hear me.
Yes, I can hear you. Thank you very much. Good morning, everyone. I welcome you to this Thought Leadership event of the Chartered Institute of Bankers Ghana. I would like to take the opportunity to acknowledge the governing council members, fellows, and associates of the Institute, the managing directors of banks, and distinguished ladies and gentlemen. Thank you for joining the event. At Chartered Institute of Bankers Ghana, our mandate is to promote the banking education and regulate the practice of banking profession in the country. This event is themed Sustaining the Confidence of the Financial Sector of Ghana. It's an important event. It's fair to say that the financial sector has experienced some headwinds in recent years. I am confident that the panel discussion, which will be moderated by the Chief Executive Officer of the Institute, is to educate all of us on where we are on confidence, what we must do to sustain the confidence and enhance the financial sector of our economy. The panel consists of distinguished industry leaders and subject matter experts. I will encourage all of us to be very active and engaged in this session as we look forward to a very interactive conversation. I thank you all once again and enjoy the discussion. Mr. CEO, over to you.
Thank you so much, Mr. President. You're absolutely right. Our mandate is to promote banking education and regulate the practice of banking. And today's event is in support of that mandate. And so once again, thank you, Mr. President, and thank you all our panel members who have joined us and audience as well. So in terms of today's event, the theme is quite clear: sustaining confidence in the financial sector of Ghana, and for that matter, the economy of Ghana. Certainly, we will address matters around the financial sector as a catalyst for economic growth and development, then look at performance of banks, given they account for 80% of the financial sector in terms of aggregate assets. We'll then look at disaggregating the performance of the industry and situate the performance that we've seen in context. But how do we account for some of the numbers, but also what are the opportunities for growth? And who are the stakeholders, critical stakeholders, to ensure the agenda of sustaining confidence in the financial sector? And what role will financial literacy play at individual level, corporate level, in protecting assets and investments? And I think those are very, very important areas of focus. We want to make this as interactive as possible. And we've assembled subject matter experts, as President mentioned, to help us with this education and certainly for this event. I'd like to introduce them shortly. We do have And let me start, ladies first. We do have Dr. Dr. Lordina Amoah, who is a senior lecturer in the Department of Finance, University of Ghana. She holds her PhD from Stellenbosch University, South Africa. She's a researcher, she's a development finance consultant, and she has significant interest in sustainability and sustainable finance. There's a lot to say about her, but Lordina, please pardon me if I don't read everything. Thank you. We do have Professor Noel Tagoe. He describes himself as a public intellectual, is a consultant, an educationist, certainly a technology, digital expert. He does quite a lot of work. He's based out of Oxford in the United Kingdom. Then we have Mr. Anthony Sarpong, who is a senior partner of KPMG in Ghana. He has responsibility for the strategic direction of the firm, has over 500 staff, done significant work across different sectors of the economy, worked in and outside Ghana, South Africa, Nigeria, and there's so much he brings in terms of experience, given his involvement in some of the specific issues relating to our industry. The last but not the least is John Awuah, who is a household name when it comes to the banking sector or the financial sector broadly of our economy. He's done significant work across different institutions. He's currently the CEO of the Ghana Association of Banks, and has been deeply involved in some of the discussions in our sector. He's previously worked with Stanchart, ABSA, EcoBank, UMP. So panel members, you are welcome, and audience, you have a lot of experience here today and insights. And our objective is to share those insights, harness them, and convert those perspectives into further policy direction of our economy. So once again, I welcome you all. Panel members, let me just confirm that you can hear me, and let's just ensure that we can hear you as well. So Lordina, please confirm if you can hear me.
Good morning. I can hear you, and I hope you can hear me too.
Yes, Dr. Amoah, we can hear you. And pardon me for calling you Lordina, Dr. Amoah.
No problem. Thank you.
All right. Excellent. So Professor Noel Tagoe, please confirm if you can hear me.
Good morning. I can hear you, Robert, and my preference is Noel, please.
Okay, excellent. So Noel, I struggle to call you Noel, but I'll try my best. John, please confirm if you can hear me.
Yeah, loud and clear. I can hear you.
Excellent. Last but not the least, Tony, please confirm if you can hear me.
Hi, confirmed. Good morning, everyone.
Good morning. Good morning. Thank you all. So what the conversation is themed sustaining confidence in the financial sector. And we want to just take a quick poll for those of us who are on this call conference, just to gauge where we are, more from your own perception of confidence in the financial sector. I believe that will set the context for our discussion. So to our audience who are on the call, please just try and complete this for us, and we'll see the results very shortly. So we are running a poll, a very short poll. So if you check your chart at the moment, there's a link there and a very simple question. Please complete that for us. So what's your current level of confidence? Your current level of confidence. And so we see quite some interesting statistics coming up. This current level of confidence from your own perspective, but also if you look at perception based on your interactions with others, either your customers, your clients, your family members, or it's interesting. We are saying somewhat confident, or some level of confidence, or not confident is coming up. Somewhat confidence is leading. Confident and very confident as well. We've seen some responses for that. Great. So I think this sets the context for our conversation and it makes the topic for discussion very relevant. And also then say, how do we continue to sustain confidence in the financial sector of the economy? So let me start with you, Noel. Just trying to, if you can help us, give us a view of the financial sector as the catalyst for economic development and growth, the importance of this sector that we are talking about, and why confidence is very important. Prof?
Okay, thank you very much, Robert. I hope you can hear my voice, and I'm speaking from Accra on this occasion. So a few things I'd like to draw your attention to in the next 2 or so minutes about why the financial sector and the banking sector in particular is important. A couple of things. One is that it mobilizes savings. I mean, those of us who have extra money that we need safekeeping for and investing, it mobilizes savings for us. And so there is some amount of money that can be offered and channeled into productive investments, and that can drive economic growth. So that's the first thing. Second thing for me is that through the financial markets, the financial sector allocates capital, so those who have the money now decide where to put it, given the risk appetite that they have, and then given also the requirement for profit or returns. So that's quite important. That allocation of capital is important. The third thing is that, as I mentioned just earlier on now, there's an element of risk involved in every investment, and the financial markets enable us to kind of pool and share risks together, either in terms of the portfolios we hold or through various insurance mechanisms, and it relates risks to the amount of returns that you have to make. So those are quite important, and we need those investments in capital allocations and savings mobilization to grow as an economy. The fourth thing that is also interesting for me is that through the payment systems, it facilitates trade, whether international trade or domestic trade. Because of that, it is really very important. When there is lack of confidence in the system, then this particular role that the financial sector can play is dampened. The fifth thing for me is the provision of credit, because normally an organization wants to expand because there are profitable opportunities for that organization. It doesn't have the money. It cannot get its internally generated equity for itself. And so it would normally go to the financial markets. And banks play a key role over here in order to get some credit over different tenures, whether it's over the short term and over the long term. And therefore, the whole issue, if you like, of the whole issue of interest rates, etc., are important, and then foreign exchange rates and so on are important. And the final thing I want to talk about is that if it is regulated well and if it is stable, that stability ports over or moves onto the overall economic stability of the country. Now, if it is not run properly and there is some disruptions over there, that also has very serious implications for the economy. So just summarizing for me in a few words, it performs all of those functions I've talked about in order for it to create a stable and efficient environment for businesses and individuals to thrive. So that's what I have to say for the moment, Robert. Thank you.
Thank you so much, Noel. I was going to say Prof. Noel, but Noel, thank you so much for setting the context in terms of the importance of the sector, economic growth, certainly capital allocation, risk management, trade facilitation, economic stability, and certainly credit creation. Thanks. Thank you so much, Prof. I'll move on to John. We know that there have been series of headwinds, as Mr. President mentioned, that the sector that we are talking about, the financial sector, kind of has faced in recent times. You can step back to 2017, regulatory reforms, banking sector cleanup, then we experienced COVID, and then the almighty debt exchange program. So that sector has been in the eye of the storm. We've seen performance of the financial sector, particularly banks. John, share with us, and I'm sure you can add something to what Prof said earlier on, but share with us if what we have seen in terms of performance exit 2022 is just situational or episodic, if you like. Share that with us. What's your thought and reaction?
Yeah, thank you very much, and thanks for having me on your program, and also to my fellow panelists and participants on this very, very important, should I call it, workshop. It's extremely important at this point that as a financial services sector, everyone who has a role to play in one way or the other comes to the table on how together we can build confidence back. So it's important that we understand exactly where we are coming from and where we are at the moment, how we got here, and also to take a step and look into the future, how banks will be weathering the storm going forward. I would like to start off with a few of the things that I get asked quite a bit. I get asked why did the banks participate in the domestic debt exchange? And the very simple answer is that it was never an easy decision on any bank. It was a very difficult decision in the boardrooms of banks. There were several back and forth. From the general public, it is possible you may not have heard from the banks directly, neither did you hear from the association in the media talking about the debt exchange, but behind the scene, significant amount of work, hours and hours on end, weekends, holidays, through the Christmas, there were discussions behind the scene to get to a program that works for the country, and also to get a program that does not destabilize the financial system. So our priority was, whilst the decision was a very difficult one, how do we participate in the decision making in a manner that through that decision process, we will come out with a financial system that may have an impact, but that does not get distinguished because extinguished, I mean, more or less, because of participating in the government's program. So from the first exchange memorandum documentation, we got to the second exchange memorandum documentation, and then we got to the third exchange memorandum documentation, which is the one that we executed in 2023. But of course, the government launched the debt operations in 2022 December. what it meant, and Tony is on this call. I'm sure he will share some light on that. What it meant, once the announcement had been made in December in 2022, going by the International Financial Reporting Standards, we had to then perform what they call the expected credit loss, because the government, who is the obligor, had indicated in December that it was going to struggle to pay the debt. And if you're going to struggle to pay the debt, the accountants will tell you that when you are anticipating a potential loss, you recognize it now, when the anticipation can be fairly measured and estimated. So that is what we saw. But what I want people to focus on, particularly when you are talking about the 2022 financial statements of the banks, is to look at the underlying performance of the banks. We saw net interest income growing by over 25%, actually around 27%. We saw non-funded income also up by almost in excess of 35%. So the underlying business of the banks were extremely strong. The banks had operated very well and were on track to delivering solid financial performance, but for the domestic debt exchange, which we knew once we went in, we had done the stress test, we had done the stress analysis, and we knew that the industry was going to be impacted in one way or the other, because of course the accountants are also sitting in the banks. So that assessment was done, and we knew, though to the general public, you saw it through the publication for the first time, but there were several iterations of the stress test based on which we had to go back and we had to work our way all the way through 3 different sets of documentation, even the bonds under the program. From 4 bonds, we all know that we had 5 and 7, which is like 12 bonds under the program. So yes, we as an industry recorded some level of, I call it a blip performance, and that is why I'll call it situational, but the underlying performance was solid for 2022, and I dare say people should go back and look at the underlying performance on interest income, interest expense, non-funded income. Every line on that profit and loss statement was showing an upward trajectory. And then when you come to the impairment on financial assets, that is where the impact of the debt exchange is assessed. But of course, we've seen the Q1 results of the banks, which goes to attest to the fact that, yes, we had recorded some negative impact as a result of the participation, but we've, as an industry, bounced back quite strongly in the first quarter results, and that goes to attest to the underlying strength of the banking system and also the resilience of the sector.
Thank you, John. Thank you for taking your time to explain the genesis of this and the rationale for participation, and certainly the number of iterations and stress testing that you've done or we've done as an industry to arrive at where we are. And I know you've passed Tony the ball to come in. Tony, I'll come back to you shortly. I think where you landed, John, is the fact that if you look at Q1, things are beginning to look even better, and that fundamentally the underlying performance or underlying business of banks remains quite intact. Let me come to you, Dr. Amoah. You've seen the Q1 result that John is referring to. Would you say that in spite of the the impact of DDP, banks are already, or the financial sector is already turning the corner in terms of performance, and we are out of the woods? What's your thought? Lordina, please confirm if you can hear me.
Thank you very much. Robert, can you hear me?
Correct, yes, I can. Please go ahead.
Thank you very much, Robert, for the opportunity to also make contributions to this very important discussion, which is also very timely. And good morning to my co-panelists and all the participants on this particular platform. So going back to speak a little bit about what Professor Tagoe said, I just want to also reiterate the importance of the financial sector to intermediation and to overall development. So as Professor Tagoe mentioned, you know, the financial sector is actually the financial backbone for any economy. And especially in developing economies, we have the banking sector that plays a very, very important role. So whatever happens within the financial sector would definitely have ripple effects to the real economy and the general development of the economy. And so whenever we talk about the issue of confidence, it's a subject matter that we cannot take lightly, because any effect of or any loss of confidence in the financial sector will have subsequent effects for future development within the economy. So the opportunity cost is really high. Now, coming back to the issue of the impact of the DDP on banks and what the results of Q1 is actually showing. Of course, from the beginning of the year, there were a lot of apprehension. There was a lot of fear about what is going to be happening to the financial sector because of the announcement of the DDEP. As we know, we heard about some of the estimations about how this DDEP is going to affect the profitability of banks, how it's going to also have an implication for their capital impairment and so on and so forth. Some of the estimations indicate that the bank's exposure to the ongoing DDEP is well above some 65 billion Ghana cedis. And they were also expected to be making some losses in the area of around 14.5 billion. Indeed, as we saw, the most important impact of this DDEP on the banks has been in the area of liquidity. We've seen that the liquidity gap has been quite enormous. And the implication of this is the fact that when these are posted, as we saw with a few banks recently, it sends some form of a signaling effect to the public. And when these signals go to the public, it tends to have an influence on the amount of deposits that banks are likely to be receiving. It tends to have implications for future lending of the banks, because when they don't get enough deposits, then there are also issues of how much they're going to be lending, and also transmit into the possibility of making significant profits over the future period. And this may also become quite cyclical, but it is very good to see that irrespective of all of these issues that we saw within the beginning of the year, it's quite commendable to see some of the banks making a rebound from the effect of the DDEP. I believe that whereas we see some form of rebound, there's still a lot more that should still be done in order to be able to get the banking sector actually standing up on its feet. As we saw from the polls this morning before we started this discussion, we could see that the confidence is really not way up there. And clearly there are implications about how people feel about the future investment, future deposits with banks. People are now very careful about, what am I supposed to do? Where should we put our money? And the banks are also now going to be in a position to rethink, even though the investment, government, the banking sector is mostly the dominant investor in government of Ghana securities because of regulatory issues and also because of market dynamics. There's still the room for us to now rethink, how do we proceed going forward? Are we going to be putting so much of the money into government securities? What are the options? What do we do in order to be able to push enough funds or enough capital to the real sector, which seems not to have been so much of the focus? even though that is what is actually going to drive a lot of their development. Like I said, it is mainly out of regulation. So there's the regulation that requires the banks to actually put a portion of their money into some of these securities. But now the conversation is moving into how much or in which manner do we go about putting monies? What is the threshold that we are supposed to look at in order to put money into some of these government securities, and rather look at increasing the loan to deposit ratio, whereas we push a lot of the capital to the real sector in order to be able to drive development. I believe that whereas we can see some form of rebound within the financial sector based on the Q1 results, there's still a lot more that needs to be done in order to be able to bring up the confidence in the financial sector to the level that can drive development and sustainable growth within the economy. Thank you very much.
Thank you, Dr. Amoah. That's quite insightful. Touching on the sector as a backbone for economic development, and certainly the opportunity cost of not having a very strong sector, that could be very high. You landed on the need for us to really learn to the real economy, and thank you for those submissions. I'll go to Tony. I know you've been quite deep in some of these conversations, also because of where you sit. Purely from an educational perspective, share with us this whole impairment treatment, this ECL, expected credit losses, and the accounting treatment of this. I think it would be good to share your thoughts. And I know when John was submitting or making his submission earlier, he indicated that there are some additional insight that people like you can share. So Tony, you have the floor. Share with us this whole impairment. Is there even an opportunity for banks to write back some of the impairment that we saw? Tony?
Thank you very much, Robert, and good morning to your audience as well as my co-panelists. Indeed, it's true, the summary that you've given and what John said, that when you look at the domestic debt exchange, many people thought it was just about managing debt or just the economic issue, but certainly it goes beyond that. There were certainly accounting implications. There were certainly financial implications that deals with managing solvency, which is capital management, and liquidity management, which Lordina also touched on. There were certainly regulatory impacts that needed to be managed. And of course, it's still ongoing, which is the taxation issues and many more. But to respond directly to the issue on the table, which is the accounting effect. So what really happened was that government has issued bonds which the banks have subscribed to. And let's say the bonds could be equated to one apple. Then in December, government said, I'll not be able to give back an apple to you, but I'm going to give you something close to an apple. And let's call that orange. The issue is the banks that were expecting an apple from government, will it give them the same value if they now receive orange instead? And this is where in the accounting issues come in. So from this perspective, two factors come into the accounting, what we call the fair value on exchange. In other words, will the value of one orange equate to value of one apple, or we needed to receive 2 oranges for 1 apple? Then, of course, the issue of impairment would come in. Even if I receive 1 or 2 oranges as replacement for apple, is the value that I'm getting from the minerals and vitamins the same if I were given that? So these prong two issues came through the accounting. And technically, as John mentioned, these announcements were made in December. And from the accounting perspective, which we currently Ghana subscribe to IFRS, for the purpose of students online, we're looking at IFRS 9 and IFRS 13, requires that when you expect a loss to come through the future, you don't wait till the loss actually hits or crystallizes. You take the loss at the material time that information becomes available. So as the bank stood at 31st December, the banks needed to estimate how much value they will lose by exchanging the holdings of bonds, which was in their books, to the new bonds that were going to be given. And how was this going to be done? One, you know that from finance perspective, the cash flows from the new bonds were fundamentally different from the old bonds. And in many ways, some people have challenged and talked about the fact that, well, if you held a bond of 1,000 and government say, I'm giving back you 1,000, then why are you talking about value change? But the issue comes in because a bank was holding a bond 1,000 to be matured in 2023, and government say, I'll pay you that bond in 10 years. So the value of 1,000 today obviously will not be the same as value for 10 years. So that creates value. The second element that also impacted the value is the coupon, or the yield that the banks were going to expect from the bond holdings. And we knew that averagely the banks yields were around 20% or coupon 20%, yet with the new bonds, it was going to, originally, as you knew it, going to be 0, and then thereafter 5, which eventually was changed to 10. But even that, we saw that it's not comparable to what the banks were holding. So if you now recalculate your cash flows from the new bonds, which is taken into account of the time of maturity and coupon payment and reduced payment, and you now compare with your cash flows from the old bond, and as we say in finance, bring it back in today's terms or find the present value, then significantly the banks were not going to receive the same value in their books when they take on the new bonds. And that meant that in December, they needed to recognize the loss in value that they expect as soon as the bonds were exchanged in February. So what the banks did was to actually do these calculations, and several negotiations, several discussions, several technical evaluations were done, which culminated in the Institute of Chartered Accountants working together with the Practice Society of Accountants to come out with guidelines. So eventually, these cash flows were more or less discounted around the region of 15%. That principally meant that the banks were taking a loss of nearly about 30%. So if you held a bond of 100 Ghana, you were eventually, with the new bond, the value you were going to get was 70 Ghana as opposed to 100 Ghana cedis. And that was a steep loss that they had to take. So these had to be recognized in the books of the banks in December. But again, one has to distill that loss. So if you look at the books of the banks, there are two categories that they place these bonds. One is what is called the trading books. So the banks normally will have a segment of the bonds that we're holding that they trade with it every day. The intention is to trade and make profit, and not necessarily to hold and collect the coupons. So most of these normally were already at fair value. So one would say that most of this category of trading books already, per the mechanics of the market, the banks had already taken some of the losses, so as it were, in December. However, there's a second category which we call the banking book, or in a typical textbook manner, called hold to maturity or held to collect. Those ones, they are accounted for, as we call it, amortized. So the banks are holding and they wait for the coupons to receive and to receive the principals at the end. for this particular of the portfolio, which also happened to be the significant component in the books of the bank, around 90% of total bonds, these losses had not been computed at all. And therefore, to take a haircut of 30% meant that in 31st December, the bank had to absorb all these potential losses in the banking book or the held to collect book. And that significantly drove the impairment recognition, as you see in the books of the bank. Fast forward, once you move to February 21st or so, when the transaction took place, one will also have to look at what we call the day one fair value loss, which is at the point of exchange, what is the total value I'm getting from the new bonds compared with the old bond as at that date. And that also had to be recognized. Of course, that you won't see it in the December results, but what is interesting is that because the bank would have recognized significant impairment, that diminishes, or the fair value loss to be taken additional would then be diminished. And in this way, this is how the accounting effect comes in. But going forward, Robert, as you said, you asked a very important question, whether some of these losses could be reversed. So yes, in principle, technically, one would say there will be, could be reversed, but in reality, when you have lost the value of the cash flows, what also means that economic terms, they won't reverse. So in accounting terms, yes, for the portfolio that is held to collect, what it will mean is that after day one fair value, the accounting model straight to what we call the amortized cost. And with the amortized cost, the losses that have been booked tend to be spread or unwind back into the P&L recognition over the life of the instrument. In this case, we are talking about some 5 years, some 10 years. But as I've said, that is an accounting reversal. In economic terms, there's no cash flow backing that. And therefore, in economic terms, the value has actually permanently gone lost. I think it's also important to add the element of taxation to it, that although the banks have booked these losses in December, when it comes to the tax laws, they are different. So the taxman will say, well, you have not actually suffered this loss as impairment. You are anticipating you will suffer. So although the banks have made these losses, in December, the taxman will still go back to them and say that, well, as far as I'm concerned, I will treat it as if these losses have not occurred. And therefore, on top of what the banks have suffered on profitability, they will still have to account for taxes that they would have made on the fundamentals of the business, as John said. But going forward, once the losses crystallize in 2023, then there's a strong case for them to take credit of these losses. So one would expect that as we are in 2023, the actual losses then can be given to the banks to manage the impact of these losses on their profitability through a tax credit that may also come in. So in a nutshell, this is the accounting and taxation effect that one has to look at in terms of the domestic debt exchange. And I will add that fundamentally going forward, what is important is that the banks focus on the fundamentals of the business to rebound back and not to look at this one-time loss, which is steep on their profitability, on their capital, but to make sure that they prudently focus on the banking business to continue to create trust and build the confidence, and we'll be able to overcome this challenge in no time. Thank you.
Thank you, Tony. That's rather very insightful. I'm sure I'm sure our students at the Institute would love to have you examine this subject area. And some of the thoughts you've shared certainly will feed into our teaching and learning at the Institute. John, were you going to, you wanted to make a submission? No, I heard a voice coming through. Great. Yes, if it's not yours, John, then I'll move on. Please go ahead, John.
Robert, that was me. Apologies for the interruption. Just to situate at this point that gets made quite quite a lot of times on the size of the securities portfolio of the banks. Is something that in every interview that you grant, it comes up. But at one point, we must also bear in mind is in that portfolio of government securities, we have other subcategories of securities which have all been characterized as government bonds. We have what we call the ESLA bonds. The ESLA bonds, how did it originate? ESLA bonds were actually actual exposures of the energy sector that the banks were exposed to and government was unable to pay, or these companies were unable to pay. We have VRA that the banks were exposed to. They had funded them in a productive manner. Unfortunately, they were unable to pay. And the answer to solving that was to issue bonds to pay them. So all of a sudden, something that was a top line exposure, moved from being a loans and advances category of like assets into a government security facility, which is not something that as banks, we went in to directly intermediate, giving government money on in that respect. Again, you remember that a few years back, 2014, 2015, 2016, we had this forex under recovery losses in the BDCs and the oil marketing companies arena, where they were also struggling. Government at that time, the fuel prices were not deregulated, so government was fixing the prices, and the FX differentials were supposed to be paid back to these BDCs. Unfortunately, government could not pay. At some point, somebody had to take the loss, and that is what also originated, to some extent, in these ESLA bonds coming into being. Again, in that bond portfolio is Dachi bonds. Dachi bonds are bonds that were issued to take care of debts owed by the GET fund or owed by contractors who had executed transactions for GET fund. They had built schools, built other educational infrastructure. GET fund is unable to pay, and again, GET fund wanted to do a lot more transactions or a lot more educational facilities. So they issued these bonds so that banks would then, who were owed, or the contractors who were owed, would then have liquidity to enable them go back to continue, finalize the jobs, or to even enter into new educational infrastructure. So we need to be circumspect when we are breaking down the level of investment of the banks in these government securities, because it's not all of them that were banks just going out and buying government bonds. Actually, some of them were bonds that were issued as payments for construction companies. And who funded these construction companies is banks. So the construction company takes the bond from the government and says, for the debt I owe you, this is how the government has paid me, and this is what I have. And then the bank will take it, and all of a sudden it becomes the bank's security. So we need to situate it. If you go back 2015, 2016, and you check the loan deposit ratio of the banking industry, you will find that it is significantly different from what we have now as a result of asset class changes, something moving from loans and advances and traveling all the way to government securities, not because the banks have actively gone to purchase, but because they've been used as settlement mechanisms. I just thought I should clarify that so that we can situate the discussions on investing in productive sectors quite clearly. Thank you very much.
Thank you, John, for bringing that perspective and clarifying that. I was going to go to Lordina before I go to Prof, but Tony, I wanted to stay with you, maybe just to clarify a point you made earlier on. The timing of the debt exchange program, December into this year, or when it was announced, would you say that that in itself was a reason for what we saw in terms of the losses that the banks needed to take in 2022? So I'm asking the question, if that timing were to be in 2023, the announcement, when the materiality of that information became available, would that have made any difference? I think you made a point earlier on. I just wanted to interrogate that a bit more. 1 minute, if you can.
Yes, so the timing that information becomes available is very, very crucial and important in the scheme of accounting. So in December, once the announcement was made, the accounting perspective is that at that point, government has signaled that I will not be able to settle you what is in your books, and therefore I'm going to give you something different. So at that point, you have realistic expectation that you make a loss, and then that is why the impairment then gets situated in the December or 31st December reporting. Assuming this announcement was made on 1st or 2nd January, what it will mean is that it wasn't available generally to the public in December. And for that matter, its impact on the financial reporting for December 2022 would not have been considered, and that the impact would have been considered from the date that the announcement would have been made in 2023. So yes, administratively, the timing of the announcement has also important influence on when to recognize the loss in the books of the relevant banks. Yes.
Thank you, Tony. And thank you for your apple versus orange analogy. I think that's very, very classic. I'm going to just go back to Lordina. It appears there are lessons here for all of us. Listening to the conversation and just based on the research that you're doing, are there, lessons that we can pick from what has happened in the banking sector or the financial sector for that matter? Lessons from elsewhere, particularly when we are talking about sustaining confidence. So how do we sustain that confidence? And are there lessons from somewhere that we can pay attention to? But also, are there lessons from what has just happened to us? If you can do that diagnosis for us.
Okay, thank you very much, Robert. I must commend John Awuah for the insightful revelations he gave about the volumes of government securities. It's quite interesting because one of the recommendations that I was actually going to be making is that banks' loan-to-deposit ratio should be increased somehow. For example, when we go to Nigeria, there are certain standards that the regulator compels them to maintain. In Ghana, we've observed that the loan-to-deposit ratio hovers around 45%. But if you look at the West African the banking sector, you can see that generally around 60% thereabout. And so why am I talking about John Awuah's question? If we are looking at the composition of loans, and there are some portions that were to VRA, there were portions that were to ECG, then clearly these are loans that were supposed to promote productive activities within the economy. And hence, the only reason why we tend to look at it as if, okay, banks are doing too much government securities is because of the metamorphosis of they being loans and advances now into the region of government securities. Indeed, nonetheless, John, it's still required that we look at the loan-to-deposit ratio, because just as we know that by regulation the banking sector is supposed to keep a portion in the government securities, there's a lot that can be achieved if we concentrate on the real sector, because like I mentioned earlier, development rests on finance to some of these households, to retail, to wholesale, corporate, and all of these development counterparts that we have within the economy. And then again, we should also be looking at the most important thing that comes to play when it comes to giving out loans to some of these parties is the issue of risk. The issue of risk plays a huge role because whereas they could safely invest in some of these government securities without, of course, the too much risk component associated with it, except for recent experiences. There's also the issue of risk that is considered significantly when it comes to the private sector. So one of the recommendations I would like to also provide is that we should look at providing efficient risk management systems. How do we do that? We need to understand our clients, the various categories of clients that we have. We look at the kind of risk that they face, and then come up with tailored risk management models to be able to enhance the advancement of loans to some of these entities. In the space of financial development, we should also be looking at collaborating with other institutions. Recently, we have the Development Bank Ghana that are into providing guarantees or collaborating with other parties to provide guarantees to relatively risky sectors in order to de-risk some of these parties so that we are able to advance a lot of capital to some of these entities, because that is where our development lies. So now the issue is, in order for us to be able to generate more and get more business for the banking sector, we need to be able to help the businesses to also come up so that government can do well in terms of tax revenue mobilization, and then economy will grow generally, and then everybody gets a good record for that. And then another thing that I also want to recommend is the fact that we should also look at introducing very exciting and innovative products. As we see, there's a lot of opportunities that we can provide to the wide variety of the customers we have by providing tailored products. Even if it's for the short term, we should look at how to manage the interest that is charged to some of these parties, because as it is now, confidence is really going on the low. And if we continue in this cycle, it may not change very well for the banking sector. So it is extremely important that we come up with very exciting and innovative products that will be able to meet the specific needs of the various classes of customers that the bank actually serves. And then on the general, in order to be able to improve the confidence within the financial sector, it's extremely important that we look at programs that promote financial literacy, programs that would help the retail investors, especially, to be able to have a better perspective about the financial sector. In this particular space, we can look at partnering with tertiary institutions in order to be able to create financial literacy clubs. We can look at investment clubs. We can look at many opportunities that we're able to help facilitate the increase in investment knowledge, increase in savings knowledge, and generally issues pertaining to the financial sector, so that we can win them. It's supposed to be a collaborative effort between the banking sector and the general class of clients that we have. So in terms of learning, I think these are some of the things that we should be looking at to improve in order to be able to get our system bouncing back into action. Thank you very much, Robert.
Thank you, Dr. Amoah, for those recommendations and the lessons from elsewhere. And certainly the fact that our real development lies in the real economy, which is advancing credit to entities like SMEs. And that's where the Chartered Institute of Bankers Ghana comes in. We're currently undertaking a survey and some kind of research in that SME to even say how do banks define MSMEs to start with. But that's another thought leadership event you should look forward to. I know we have about 240 people listening to us right now, and I know that that's quite significant at this time of the day. So the messages are getting across in terms of the education, which is our mandate. But Prof, I know you've been extremely quiet, and so I'm coming back to you. I've heard your assertion that in times of crisis, there may also be opportunities, and that good companies survive or thrive in times of crisis. It would appear that the sector has faced significant headwinds, particularly if you listen to what Tony said, that whilst we are taking losses, we also have the tax side, taking cash flow away from us. But where should banks focus, and where are the opportunities from your perspective and listening to all the submissions so far?
Thanks, Robert. I think there are a few things that banks need to think about. But before I just do that, I like to just extend slightly what Dr. Amoah had said in terms of the what lessons we should learn. There are at least 3 arenas in which we should learn the lessons from. The arenas within our policy spaces, if you like. The policy space of managing the economy as a whole. And I'd include the fiscal space primarily over there, but industrial policy, etc., and so on. Because these things have their beginnings and also have strong connections with how the economy has been managed and how resilient the economy had been to external shocks that have come. The conclusion I'll draw was the fact that we didn't have the resilience and the robustness that we needed in order to weather those storms. So if you like, that's the first thing. And then there's where lessons should be learned also with respect to the sector as a whole, the corporate sector, but primarily the banking sector itself. And I include regulators in terms of that. And regulators should also learn lessons. And in particular, for me, is the connection between fiscal policy and monetary policy and how it flows through are important places for lessons to be learned. And then the final arena is really where individual organizations, in particular for me, the banks, what lessons should they learn from that? And I think that the key issue, again, is ensuring that individual organization and banks manage themselves in a way that they create space that will make them robustly resilient to some of the things that have come that hit them. And that has been demonstrated to some extent, and 2013 first quarter results shows that there is some journey towards recovery. How strong and how embedded that recovery will be, we'll be looking at that. But the encouragement to those who are managing the banks is to do something in that space. So let me come to opportunities that exist. I mean, we talk about don't waste a good crisis. And let me quote somebody else, as a word, who says that when the wind is blowing against you, you know, the pessimist will complain, the optimist would expect things to change, but the pragmatist or the realist would adjust the sails so that they're able to move according to the wind. And so what I'm going to say is not from the pessimistic side, which is complaining. It's not also from the optimistic side, which is expecting things to change. It is from the realist and the pragmatist perspective. Dr. Amoah already talked about the things that need strengthening. I'd emphasize them again: strengthening governance mechanisms within the banking system, individual banks, strengthening risk management, and strengthening credit management in terms of that. Strengthening the ability to allocate resources between different competing needs and so on. That is a key thing I'd say. And then I also look at new avenues, and Dr. Amoah had made reference to some of them. One is the kind of products that they are. The paucity of the diversity of products on the market is astounding, and this is where we need innovations. However, I also note that this is a heavily regulated environment, and that because of that, the regulator imposes almost by default brakes on innovation. And how do you break that brakes on innovation? Fintechs and others are not that heavily regulated anyway, and they have an innovation head start normally. So collaborative partnerships with fintechs, etc., might break that innovation logjam, and by the back door, banks can begin to reap the benefits of innovative product positioning and so on. And then also to start looking at who they are lending to, in particular, in fact, where the business should go. If we break what banks do, again, three main things: collect money and keep the money safe for me and use it for whatever you want to use it for. Help me make payments, and then also give me money when I don't have the money, and so on. In terms of credit, I think the SME sector is a key sector that needs to be looked at again. I mean, there are several things that militate against SMEs receiving credit. One is just the quality of management over there. But we've said that for the past 50 years. I mean, it is in the interest of players within the ecosystem to begin to improve the management of SMEs, or to begin to put at their disposal new ways of thinking about running organization, including how they approach strategy, how they adopt change management processes, etc., and things like that. That ought to be done. I mean, we cannot forevermore postpone that, because if that is a stumbling block between getting them money and helping them improve the real sector, we ought to address that stumbling block. And so that is not only for banks to address, but it is banks who would help us, who should be part of that and bring some people in there. What we need really are John Awuah's organization and AGI coming together, because they have massive convening power to bring the various players in and to begin to look at how things like that could be handled. We have seen that done in areas in Pakistan and others with even micro organizations, and things like that. So it's not outside of the bounds of possibility that GAB, AGI, and other key ecosystem players coming together cannot break the barriers towards lending to SMEs. That is this thing. And then, of course, John had talked about the diversification of the revenue base. In my view, without that diversification of the revenue base, the banks would have suffered really, really, really badly. So the fact that they were able to survive the huge crisis and they are beginning to recover even adds more argument to the diversification of their revenue base. And I think we have to look at that. I have two more points to make. The penultimate point I'll make is understanding their customers. I think Dr. Amoah made reference to that. And one of the things that amazes me as a small business person, in addition to my academic work, is the fact that when I go to the banks, their KYC, know your customer, is regulatory driven rather than business driven. And I understand the fact that it has to be regulatory driven. So the message I get from them is that we don't trust you. You are kind of you might run away with our money. You might do money laundering and things like that. And they have to build defenses against that. But they make no attempt to know my business and to know where we can create and extract value that is beneficial to each other. And that has to be done. And that has to permeate. Sorry, can you hear me, Robert?
But I can hear him.
Yeah.
Yeah, Prof, we can hear you.
All right. So I'm saying that there has to be a movement away from only doing KYC from a regulatory perspective to adding a business perspective to it. So I want to know the businesses. And one of the things I've said across Ghana is that, you see, when an economy is going down, there are different types of organizations that you relate with, and they have different needs. And you can rebalance your portfolio and your service of those organizations differently. So there are those who are pro-cyclical. They go with the economic cycle. So when the economy is going down, they are going down, and they need different support from the banks. Banks will have to know how to deal with them. There are those who are counter-cyclical. When the economy is going down, they are going up. So, for example, if we are in COVID or in a pandemic, people are dying, coffee makers are doing good business. The banks will have to know that, because they are at different stages of the business cycle and their needs are different. And then there are those who are acyclical, country broke, country not broke, we day inside kind of people. The banks should know how to deal with them. And in my dealings with banks, I have not seen classifications of customers, particularly corporate customers in that area, that will help move it forward. The final thing I'll say is that banks should also learn to manage their expenses very well. In fact, all organizations have to learn to manage their expenses very well. I'll capture it under the rubric of learning to do more with less. So there have to be what I call not just cutting expenses by heart, but understanding the drivers of expenses, etc. There's a lesson that I learned in one consultancy assignment with Microsoft that helped me so much. I mean, they, on the advice of two teenage boys, decided to split expenses into 5 categories and manage expenses that way. Let me just mention them. There were those they call the value-generating expenditure. So anytime you spend money, it generates value, and it often generates value in multiples of that expenditure. You've got to keep at that, because that's where the fundamentals of the business lie. The second one is the value-enhancing expenditure. Now, it does not necessarily generate value, but it makes the generation of the value easier for those who are generating the value. That one you can increase slightly or you can maintain. Those ones you don't cut. And then there is the value sustaining or the future value kind of expenditure. The ones that are your investment in innovation and research and things like that, that will bring you the next generation of products, but the next generation of processes that will ensure efficiency and things like that. Whereas during hard times, you might not want to increase them. Be careful, don't cut them. And then there are if you like, the value neutral ones, which are the ones that has to do with regulation, etc. I mean, regulatory costs will be there. You might not be able to cut them, but you have to manage around them. And then there's the value destroying expenditure. It yields nothing to you in there. And there seems to me a lot of value destroying expenditure over there. And in the case that I refer to, Microsoft was faced with cutting a particular expenditure in an area. And once they categorized that, the recommendation went rather that increase the expenditure in that area ballpark, but make sure that you reduce the value. In fact, not even reduce it. You drastically cut out, if you can, the value destroying expenditure. When that happened, they found out that although expenditure increased, revenue increased even much more than that. So opportunities abound. We don't have the time to talk about all those opportunities. And by the way, if I talked about all those opportunities for free, where am I going to get my money as a consultant from? So that's another. But there are, and we've got to look at it. And the days in which you kind of run a business without knowing the business, knowing the ecosystem of the business, not collaborating with people and running as an individual will not work. And the job of managing a business has become even more important, more difficult. But that's why people like Tony and Johnny Awuah paid a lot of money, and Robert Jatto and Lordina and I, as academics, are paid less money. Thank you.
All right, Rob, I'll thank you for where you've landed. I think this just listening to you, like the icing on the cake. I know Tony has been fairly quiet. We want to open this up for some interactions from participants. There are a number of questions coming through, but we also want to take a quick poll. And the poll is really looking at who are the key stakeholders and who are the most important key stakeholders when it comes to sustaining confidence in the financial sector. As a Chartered Institute of Bankers Ghana, and I know we have a role to play, part of which we are doing today. Is it the regulator? Is it the practitioners? What about customers? What about the judiciary? Because I know some of the loans that go into default get stuck at our courts. Once we try to put the poll up, Tony, any quick reactions from you? I know you've been quiet for a while. Any reactions?
Thank you, Robert. Just to add on to the resilience angle, as we really said, the banks have taken a very hit, and we're beginning to see that they are turning back, but not completely out of the woods. And therefore, for me, one of the basic suggestions is the relationship between the banks and the customers is anchored on trust, and trust which find itself eventually in confidence. And therefore, it's imperative that even in these difficult times, the banks are able to continuously provide that trust in terms of depositors having access to their funds if they need to. And that then will require that the banks look at their liquidity management, because if there's any slightest semblance that depositors cannot have access to their funds, it will deepen the weak confidence, sort of somehow confidence that we have, and the consequences can be there. And so part of the resilience, in my view, is that the banks continuously look at their liquidity management and ensure that what will take away trust doesn't arise. And of course, we know the regulator has given some assurance that when it comes to liquidity, they are putting in structures for the banks to be able to tap in. So that's one level. And at the level of the banks, that is also one as well. Then, of course, we talked about building the resilience also. Clearly, these days, investment in technology and digitization cannot be overlooked. And we see our banks doing heavily in there. The tendency is that in times of difficulty, you could look at that and say, okay, should I cut the investment in technology and digitization, which is actually, as Prof said, could be your sustaining value looking into the future. And therefore, in looking at this in this situation, my urge to the banks is to say, okay, even if it has to be slowed down, it should not be a situation where we are cutting, but we are managing to slow it down, and things get better. We get back to the normal increasing level that we have in, because by and large, the world is running on platform, the world is running on digital pooling, and almost everything is going there. So if we let these challenges take us away from investing in the right technologies and platforms, what it will mean is that we may not just be 1 year behind, but we may end up in decades behind. So part of the forward resilience is to continue to invest in technology. And then, of course, I think John already explained all the dynamics around portfolio diversification, but one cannot completely, notwithstanding all the push pressures and everything, one cannot completely take one's eyes from that, and therefore continuous look at the diversification of the products, and which is a basic finance, so that when even in crisis, the banks will not be found wanting in terms of dependency in one product. And that's something that the banks must continue to look at as we look forward to build more resilience in the sector. Yeah. Thank you, Robert. Yeah.
Thank you so much,
Robert,
Tony,
back to you.
and thank you. Yes, can you hear me?
Yes, we can hear you. Robert,
Excellent.
we can hear you.
Okay, so it's interesting. Thank you, Tony, for where you landed. It's interesting what we are seeing in terms of the key stakeholders, or the most important key stakeholder is sustaining confidence in the financial sector. The regulator comes very top, the financial institutions. But what strikes me is the development partners. Zero may mean that we should own our own destiny and leave development partners alone. But this week, we heard just yesterday that the IMF board is intending to approve our 3 billion facility. And that in itself would mean some stability even for the sector. But not many people on this call think that they are very key to the stability or sustaining confidence in our sector. I think that's something we should pay attention to as well. But it's an interesting pool or perspective that we are seeing. We're opening this up for some questions. So those who want to ask questions, our audience, this is the time. I see a few hands up already. Eric Insako. Eric Insako, you do have the floor. Your hand is up. Please go ahead. Can Eric hear me? Okay. Whilst we wait for Eric, I think the mic is disabled. Team, let's enable Eric Insako to be able to.
Okay. Thank you very much.
Excellent. Please go ahead.
Okay. So I put a comment earlier because both from the questionnaire and from the discussions, we've discussed everything except fintech. And some of you know that I was head of sales of MTN from 2013 to 2021. And I feel that, it is not by accident that probably about 10% of the banking sector is now fintech float. And I just wonder, I spent 2 years as head of engineering of Stanbic Bank, and I gave up on the banking industry's ability to digest the issue of the fintech opportunity, and I left. But I just wonder why it does not occur to anybody that this is the new frontier, and why we have not assembled a strategy to get it right.
That's an interesting question. I think Prof in his submission talked about that to some extent in terms of the collaboration. But I would park the question. Certainly someone will respond to it shortly. I see another hand up. So Kojo Daku, Samuel Kojo Daku, you have the opportunity. Please go ahead.
Hello, thank you so much, CIB, for organizing this program, and for the panelists for such insightful, knowledge you have shared so far. Mine is not a comment, mine not a question per se, but rather a comment as to who are the main stakeholders to really build the banking confidence. I think the regulator will play a key role, as you have seen from the pools, and then the banks themselves, where they would have to issue regular communicate and service. Thankfully, the Ghana Association of Bankers have been doing that. I've been reading their service, telling us about the resilience in the banking system. Okay, so I think, yes, you mentioned the development partners, they come in once a while or when occasions arise, but the bank themselves, they are the main drivers for building the confidence. When people come to the bank to withdraw their money or to access some kind of financial services, what do they experience? Is when they leave the bank, the experience they encounter is what they are going to spread across, whether or not the banks are resilient. So I think the duty falls squarely on the bank themselves, and to some extent, the regulator will play some complementary role in this regard. Thanks so much.
Thank you so much. Thank you, Samuel. Customer centricity and the experience, you've touched on that. Excellent. We do have Isaac Amoah. Isaac Amoah, please, you do have the floor. A virtual floor, I mean. Isaac, please, can you hear me? All right, so let's go to Eric Niboy. Eric Niboy, your hand is up. Please go ahead. Okay.
Hello. Hello.
Yeah, please go ahead.
Good morning, and thank you for the opportunity. I had some connectivity problems. I couldn't get in right when it started, but then I've come to enjoy myself in the last 20 minutes. I heard one of the panelists talk about the loan and deficit ratio, where we need to seek an increase. I'm tempted to suggest that we look at such suggestions very carefully before working at them. I remember in those days of Basel I, the requirements under Basel I were not as rigid. But then we saw it in 2008. Fast forward into our environment in 2017, during the banking crisis. There was so much noise about the capital adequacy ratio, liquidity ratio, name them. I'm careful here about the loan deposit ratio and wanting to increase it, because in the calculation of the loan deposit ratio, the loan may be a numerator and not a denominator. But in the capital adequacy ratio calculation, loan is a component of the denominator by way of risk-weighted assets. And so, yes, we might want to increase the loan and deposit ratio so we'll be able to lend more from deposits. But we need to match them against what to have on the capital adequacy ratio as well. That's very important, regulation. My second point, I heard Prof talk about bankers working with the regulatory bit of the KYC policies or strategy more than the business bit of it. And I have a bit of a problem with that one there. I'm going to move into the stakeholders when it comes to confidence, to link it to that assertion between regulatory and business as far as KYC is concerned. The banking environment is the most regulated entity besides aviation in the world. And we need to get used to it and work with it. And so when we talk about regulation and confidence in the financial service sector, it begins with the regulator-related relationship. That is what for the banks to be able to enter into the industry and serve their customers. It is not a coincidence that if you take any good banking textbook, the first part of the textbook talk about the banker and customer relationship, which sits on the foundation of the law of contracts. Once again, regulation. So our business of banking is so much regulated and regulatory inclined that any compromise of any part of our business will not augur well for us. We've come to a situation where we've had a lot of brouhaha between the regulated and the regulator. We saw it in the just ended DDEP program, and all that went on. But again, if we will come to the realization that regulations are meant to be complied with rather than enforced. Whichever way we look at enforcement, it will be the regulator complying with the regulations. So why would we want to call the regulators compliance with the regulations enforcement? Meanwhile, the regulator only comply with its provisions in the regulation only when the regulated refuse to get regulated. And so when it comes to regulations and banking, they are very much inseparable. And we need to come to that realization very quickly around this time. And when it comes to looking at examples, rather, we spend much more time looking at our circumstances in the face of our laws, because most, if not all, our laws speak to our jurisdiction. And of course, it is not by coincidence also that internationally it is recognized that where international directives and what have you sort of contradict or conflict with the laws of the land, is the laws of the land of that land that matters. And so regulation, very important for our business. Let's come to terms with that one and seek to work with it so that even in our business thinking, we would take regulatory first. And so we will need to be mindful of this and take ownership. Thank you very much, Mr. Moderator.
Thank you so much for your submission. That's really, I sense the passion with which you made that submission. The next hand I see here is Sophia Palm. Sophia, you have your hand up. I have a number of other questions that have come through to me as well. I'll read them out shortly. Sophia, let's hear your voice and your question or suggestion.
Okay, thank you very much, Robert. I wanted to touch on the loans as mentioned by Lordina. I think I even made a quick submission in the chat. And what I wanted to say is that we really need to look at our judiciary and how we adjudicate loan issues, facility issues, or recovery issues in Ghana. That aside too, as a country, we also need to look at how the various systems work to make KYC better. By that, what do I mean? I know Prof mentioned that most of the time for us, the banks, the KYC is just to know who is the directors, who is this. But increasingly, we are in a country where someone can easily fold up one business that they are owing volumes and volumes of funds to a certain bank and open a new business entirely, run that business as if nothing has happened. And really, the bank that lent in the first instance or any other person, their hands are tied. Nobody can do anything because as a country, our ability to trace people doing multiple things and beating the system is very low. And as I mentioned in the chat, we all really do forget that what these funds that we see the banks holding is actually for all of us. Myself, yourself included, our savings in the banks, the other corporate savings in the banks. So in essence, the banks too can't just say, okay, we want to increase our loan to deposit ratio and go on lending spree and get people's funds locked up. We saw banks do that and we saw them go down in 2017. Another point I raised was there should really be engagement with the government on how the government also pays their partners who the banks are lending to. We saw one of the banks in 2017 crying out and saying that, see what, most of our loan books are funds lent to contractors who worked for the government. Can the government just pay us? We were all very much quiet on that issue, but really, if the government had just paid them, the contractors, what they needed to have paid, that bank probably wouldn't have hit liquidity issues in the first place. So when it comes to the banks, we all fold our arms and just because we see their financials all glossy, we are like, oh, they don't do much and they need to do much. But most of the banks that went down in 2017, if we will be fair to ourselves, these were the banks that were playing heavily in the SMEs, playing heavily with contractors who were doing business for the government, who needed to be paid. And as indeed Mr. Awuah said initially, a lot of us were crying out about why is the bank doing a lot of government securities. But by the breakdown, we realized that some of the securities, probably 1/3 or even not more, are actually funds that the bank lent to people and partners of our developments, let's say local development in Ghana. And the government said, you know what, I'm not paying you, I'm paying you with a bond. And now the banks have to even now restructure that same bond again. So when it comes to the banks, yes, I do understand we can do more, but some of the real issues need to be discussed. And it seems that for us as bankers, we are unable to make our voices loud because you are highly regulated. You don't want to be seen as fighting your regulator or fighting the government who is the owner of your regulator. But some of the hard discussions really need to be put down. Someone mentioned Nigeria. Nigeria, like this, implemented the BVN. So they are able to trace you throughout all your banking relationships. So you can have 100 accounts, 100 businesses in 20 different banks, but by the BVN, they're able to trace all to you. So where banks can easily lend using right of set-off and other stuff as a means of security, we can't do that here. So if we are seeing Nigeria probably loan to deposit ratio higher than Ghana, these are some of the practical measures that I think that the conversation should be taken at certain quarters and should be forced and certain implementations done. Then we can actually strike a law. When Nigeria did that, their central bank has
Okay, Robert.
It's the banks. Then we can
Robert, yeah,
bring their best foot forward, and I think that the economy will just be better off. Thank you.
Thank you so much, Sophia. I think John wants to react very quickly. John, please come in.
Yes, yeah. I just thought that maybe the questions, if we can keep them a bit short, so that we can pick a lot more of the questions. But Sophia has actually taken the wind out of my sail. Every point that she has made is a point that I have noted here to actually capture in my other closing remarks or something. Anything that is forced on the people does not result in proper compliance. So anything that is legislation-driven, rule-based, becomes in the end something that could even come back to hurt the system. What, as a country, we all have to work on aggressively is how do we improve the credit environment? She mentioned the judicial system. It takes on average 3 to 5 years to run through the judicial system for a recovery of a loan. When the customer is known very well to have defaulted, the customer becomes the champion in our courts. He is the elephant, the bank becomes the antelope. So we need to be careful pushing something that will be serving the top line without fixing the underlying problems. Banks have entered execution only to find out that the documents that Lands Commission has endorsed and registered, somebody has managed to have alternate documents and disposed of the assets. We are in this country, that is the situation we are going through. Everybody on this call has a story about money they gave to a friend or a family member who has disappeared, who has stopped calling. It is these same people who come to the banking system, they take personal loans, and you see the Ghana's non-performing loan where it is 15%. Every 100 Ghana cedis that banks in Ghana give out as loans, they are likely going to lose at least 15 Ghana cedis. The depositor brought you 100 Ghana cedis. When it comes to your banking hall, he's looking for the 100 Ghana cedis plus interest. Meanwhile, when you give it out as loans, you run the risk of losing 15 Ghana cedis. And if you're not careful, the entire 100. So we need to have a big discussion that addresses the ecosystem and the credit culture. people who are defaulting in their rent, property rent, are able to access lending from the banking system. This does not happen in any forward-looking country. So again, I know as a country we are making some progress in the digital side. Ghana Card is helping us gradually. Sophia talked about the BVN in Nigeria. I believe Ghana Card will ultimately take us to the same destination. But how are we fast-tracking our move? How do we make sure that NIA and all these institutions that have been taxed to ensure that this extremely important national agenda is executed flawlessly? But now we know, even with SIM card registration, people saying that some people have managed to use their SIM card, their personal SIM card, and attach several their Ghana card and attach several SIM cards to them without their knowledge, and those ones are being used for fraudulent transactions. So our environment is extremely, extremely risky, and we have to recognize that fact and work aggressively on it. So the loan to deposit ratio is something that will result almost automatically or seamlessly if we fix the underlying issues. When the 2008 banking crisis happened, and particularly in the advanced countries, in overnight, look at the number of households that in America they foreclosed. The banking system were able to foreclose. In Ghana, it would have taken us 10 years to be able to do that. It took them 3 weeks, and we had several houses on sale because they didn't have to go through any kind of legal conundrums to be able to do that. And what that does is the bank can then get liquidity and lend to the next customer. So when you're talking about loan deposit ratio, we need to balance the discussion really, really, really well. And my friend who from Stanbic, former Stanbic staff, who talked about the fintechs, if you have monitored the media, just this last week, I was on air and I had said that the future of banking is going to be banks metamorphosing into gigantic or big fintech houses. Technology is not going to be the enabler of banking practice anymore. It is going to be the business of banking practice. And in Ghana, that recognition is there. When COVID happened and we moved all of a sudden to digital platforms, the banks did not start investing when COVID happened. The investment had been made, but of course, you need some push factor. When people decided to use the channels were already in place. So there is significant investment going on in technology, digital financial services, and the banks are collaborating very well with the fintech community. I'm sure it's an ecosystem that together we can help to develop. I just thought I would bring these kind of perspectives into play. Thank you very much, Robert.
Thank you, John. That sounds like your closing remarks, but I'll come back to you very shortly. I have a few questions here. Some I think have been addressed. Some are just opinions. Dr. Lordina, you are right when you say that the banks need to take advantage of the credit guarantee being provided by the development bank, and also because banks are utilizing or are not utilizing the GESAL scheme, which is intended to de-risk SMEs or businesses. So that's from Kojodako. That's from Kojodako. Then we do have Professor Noel Tagoe. If you could repeat your KYC business angle 1,000 times for banks to hear. I think that's a comment. Then there is, so this is more around what percentage of banks' deposits are supposed to be kept in government securities? And there's a connection or a connecting question, which also says that it appears in Ghana, banks are significantly exposed to government or disproportionately exposed to government bonds. And so we saw the impact of DDP. Please, why do you think now, so this is now being directed at John. Why do you think your members, which is banks, heavily invest in government security instead of treasury bills? I believe treasury bills are also government securities, but I suspect you're saying huge exposure to government instead of the real sector. Then did the bank use 100% of the instruments for bonds? So that's a question. Great. So I think I'm reading this. So in your closing remarks, panelists, you can just summarize your responses to them. Sophia, I think you've asked your questions earlier, so I won't read that again. But I think you touched on, again, the judiciary, and I think John has explained that quite well. Please, what is the current loan-to-deposit ratio for banks in Ghana? Is there any law restricting banks to maintain a certain minimum loan-to-deposit ratio? So that's a question. Now, there's a question here, Mr. Gordon. I'm not sure there's a panel member called Gordon. Maybe Tony, right? Did the banks use the effective interest rate to discount the amortized cost? And if they did, what rate was applied, please? Did the banks use the effective interest rate to discount the amortized cost, I believe, of the instruments? And if they did, what rate was applied? Tony, I know that in your earlier submission, you indicated some rates, so maybe you can re-emphasize same. I see a few more hands up. So I have Isaac Asamoah, if you're still, and then Festus Nidako, if you will take the floor, and our panelists will summarize. We are running out of time. We have literally 6 minutes, so please keep your questions short for us. Festus? All right, so let's go to Isaac Asamoah.
Good afternoon.
Good morning.
Good morning. Thank you. My question regards the law, which the banking sector is required to keep some money in government securities. Now, following the DDP, can there be an amendment in such a way that it will not be compulsory that banks will have to keep certain amount of money with the government securities? That's
okay.
If the law can be amended.
All right.
That's my
Thank you.
Okay.
I'm not sure if it's banks. If you are referring to pension funds and the likes, but maybe
banking
John
sector
would clarify that. Okay, thanks. Thank you very much. So do we still have Festus? You want to ask a question?
Yes, thank you so much. My question has earlier been addressed by one of your panelists, so I think I'll leave it there.
Excellent. Great. Excellent.
Thanks.
Thank you. Isaac Asamoah, do you still want to ask a question? Okay, excellent. So I don't see any more. I don't see any more hands up.
If I may.
Please go ahead, Isaac.
Please, my system is giving me problems, so I'm not able to raise my hand. Yes. We hear a lot lately about sustainable financing, ESG, and what have you. I want to find out about the extent of the availability of sustainability products on the Ghanaian financial market, and whether the overall value is impactful enough to help us deal with some of the challenges we are going through. Thank you.
Thank you. I suspect that's Bernard Boateng from Kumasi, Chartered Institute of Bankers, Ghana. Thank you, Bernard, for your question. I'll take the last one. I am with the University for Development Studies, a business school. I totally agree with Madam Lordina's point on financial literacy education through the universities. We look forward to collaboration. Thank you. Let me seize the opportunity and say that as part of our 60th anniversary celebration, that's Chartered Institute of Bankers. We'll be organizing some financial literacy programs and we'll collaborate with you. And I'm sure John and our members who work across the various banking institutions are prepared to support us, because I think that's really what it comes to. If we can all become ethically wiser, but also financially wiser, some of the issues may just go away. I'm going to do it this way. Lordina, you have the first opportunity to wrap up for us. Maybe your closing comment in 1 minute, if you don't mind.
Okay, thank you very much once again, Robert. I so happy to have all the discussions, to take part in all the discussions that we've had today. Indeed, it's been quite passionate. I could sense from the responses and the questions and the comments that we got that, I mean, this is a topic which is of relevance, and it's really, really an issue that boils down to the core of the things that affect society and in Ghana in recent times. From the discussions, we can also see that the business of banking is becoming very dynamic, is becoming very, very, very sophisticated. One of the things that we should take note of the fact is that right now, the banking sector is expected to be having a lot of collaborations with a lot of institutions. In the area of ESG, we can see that banks have to collaborate with EPA, they have to collaborate with other development partners. In the area of information, we talked about information, they have to collaborate with the NHIA. And right now, even as we are talking about the issue of building confidence, it's still very important to collaborate with so many other institutions in order to be able to rebuild the confidence that we've had in the financial sector. But one thing that really stands out for me is the fact that the whole ecosystem of our credit, the ecosystem of credit, the credit culture in Ghana is something that we need to look at. Robert, you seem to have one person missing on the panel. We need a government representative who is supposed to take away all the issues that we've discussed here concerning creating the enabling environment for both the banking sector and even the SMEs, the businesses that are working within the ecosystem. Because on one side, we have banks and the issues that that challenge their businesses. On the other hand, we also have all these entities with their uniqueness, with their unique characteristics that the system, the governance system within the economy, the institutional system within the economy is supposed to address. So we need a party that takes the views of both parties and ensure that we have an enabling system. So there's one party that next time, if we're supposed to have this discussion, you have to bring on board the government partner who is supposed to send all our concerns to the ministry for them to be able to put in place all these measures in order for us to be able to see some kind of we can see a new development, or we can see some general increase in the level of development. But to wrap it all up, I want to say that all is not lost. There's a lot that we stand to still benefit from, especially because of the opportunities that such platforms create for us. So we should not lose hope. We should keep hope alive. We should know that a lot of the discussions, if taken into action, is going to give birth to a very good system, both for the financial system and the general economy for us, and we'll be able to reap the benefits thereof. So thank you very much for the opportunity, and over to you, Robert.
Thank you very much, Dr. Lordina Amoah, for ending on hope. I would go to Tony. Tony was my former boss, still my boss, once a boss, always a boss. And then John will have the final word. Prof has asked to jump into another meeting. And may I crave your indulgence? I think we've just gone past the 12 o'clock hour. Maybe 5 more minutes to wrap this up. Tony, you have the floor.
Thank you, Robert. So before I give the wrap up, I think there was one question relating to what discount rate was used. And I just for the purpose of education of our students. So we did mention fair value calculation. So when you are doing the fair value calculation, you use market observable rate. So it is not a rate that is implied in the instrument, but what the market is trading at. So in terms of the bonds, one has to look at the history of yield curves that have been traded, and in particular as of December. So in terms of the impairment or the fair value calculation, it was based on market observable rate. And so generally, if I look at the industry, was around 15 to 16%. Thereafter, subsequent amortization measurement then goes back to the use of the effective interest rate if it is held to maturity. If it is fair value instrument trading, it continues to be at the market observable rate. Having said, I think it's been an interesting conversation. And in terms of wrap up, I will still anchor on banking as a financial intermediation that actually serves as the oil that greases the entire economy. And therefore, if we lose this grace of banking, that really moves the economy around, then basically we bring the whole economy to a standstill. But to do that is to build on trust. And I take trust from both the perspective of banks and perspective of customers as a key stakeholder. We've talked a lot about the loan deposit ratio, and we've talked about the issues around the structures like the judiciary, the collateral, and everything. But most importantly is the character of the Ghanaian customer. When we are applying for loans, is it our original intention that there's a free money and I'm going for it and I'll not do anything to pay back? Or sometimes it's just challenges. But most of the time, people go for loans, and once they have received the money, they either divert it from what they intended to use it, so they don't intend to bring it back, or even when there's a challenge that they need to openly be transparent and discuss with their bank, they will get lost. So that fundamentally then drives all the other behaviors. And in the bank doing so, of course, they are taking people's money and they need to manage that. For me, the trust also starts with the customer. We must be trustworthy when we are dealing with our banks. Then, of course, in terms of the banks, continuous focus on transparent governance, good policies, and risk management will also ensure that we protect the depositors' money and invest them in portfolios that are rightfully protected. But the other element that have also come in is also partnership and collaboration. And I think we talk about it within the ambit of fintech. And Eric did mention challenges with the bank. I think for this is an evolving area. And typically, as you see in most African businesses, sometimes what ought to be partnership and collaborator is seen as a competitor. And therefore, sometimes coming together becomes a difficult. And we see that in our family business settings. But what is clear is that in moving forward into the future, technology, fintech, digitization is going to be banking itself and not a tool. And therefore, we need to definitely see all these interplays as collaborators, as working together, as partnership to deliver just the simple banking business of taking deposits and lending to those that are. And finally, I will say that for bankers as well as customers and all other stakeholders, if we look at banking again within the context of ESG, then we are talking about how do we use banking to improve the environment? How do we use banking to improve our social settings? And how do we use banking through governance and transparency? And if we're able to look at it that if we are truthful both from banking and customer side, then socially, when you're able to do your banking well, it improves your individual lives, your family lives, as well as the entire economy. In the same way, if a banker sees governance as an important element, that actually helps them to be sustainable, to be resilient, then they'll continue to be in business. And together, if we do this very well, then of course, environmentally, which then also includes not just the physical environment, but the economic environment, the financial environment, will then also be suitable for all of us. And all of this will work together to improve the confidence that we so desire in our banking sector. Thank you, Robert. Yeah.
Thank you so much, Tony. Thank you. We're extremely grateful. The Ghanaian character, or the character of the Ghanaian, and our original intentions when we take loans. John, before I come to you, and I think Tony is speaking to all of us, really, all of us. We are all Ghanaians. So before I come to you, there's a link we've just put in the chat. So please click on it and just give us feedback on this event. Certainly that feedback will help us improve the next one. And Dr. Amoah, thank you for suggesting that we get some policymakers onto this platform as well. So that has been noted. But please complete the feedback for us. And I think as an institute, we have a mandate as well to focus on not just education, but also regulate conduct of practitioners in a way that we can drive ethics and professionalism across the industry. I'll come back very shortly as I hand over to John. John, your final comments and reaction to some of the questions.
Yeah, thank you very much. From what I have here, I believe the last one that is the last question that needs some answer to is whether there are any laws compelling banks on loan deposit ratio, on what loan deposit ratio or government securities banks have to invest in. Presently, the Banking Act at 930 does not compel banks to invest whatever percentage in government securities. So there is no regulatory kind of push for banks to buy government bonds. But there are prudential requirements on liquidity that make sure that a certain portion of your deposit is channeled into vehicles that you can easily liquidate, what you call cash and cash equivalents. So that in the event that a customer walks into a banking hall, a customer who gave you fixed deposit for 1 year, after 1.5 months comes and says, oh, I have an emergency, I need my money back, you'll be able to find liquidity and pay this customer. So those liquidity ratios and other prudential requirements will mean that banks will have to put a certain portion of our resources in cash, some in near cash, and a lot of it in loans and advances, which is the core of our operations. So I believe I've been able to provide some clarity on that. But Robert, and to the Chartered Institute of Bankers, this has been a very engaging, active deliberation. I believe we have to do more of this. It's important that as practitioners, we also spend time to educate and also to learn. It's through these kinds of fora that we can also hear from the people we serve, so we can change course if we have to. Clearly, from the get-go, the regulator's importance has been highlighted through the survey, so I don't want to even go there again, but the regulator providing some market assurance is something that as an industry we will need to sustain confidence and trust. And the governor of the Bank of Ghana throughout the process, did very well in taking the market along and telling the industry and banking practitioners and also the general public that they will do everything to ensure that all banks stay afloat, and that they have regulatory measures that have been rolled out that will enable banks to traverse these difficult times. As banking institutions, and also particularly educational institutions, Robert, and here I'll put you and Dr. Amoah, since you are on the panel, that we need to be able to build case models around situations such as this. We don't have to waste this. We need to build case studies from how as a country we got here, how the market responded, how the program, we negotiated our way through the program. We have to document this for posterity. This is our 17th trip to the IMF. I don't know how many kind of documentations we have on the 16 others that we have had. So I'm tasking you as educational institutions to take this on board and build stuff around this that we can use to, as learning test cases for our students and also for practitioners. The issue on financial literacy has been highlighted severally, and it goes to point to its importance in this debate on confidence and trust. So it is not about a bank surviving, it is about an industry or a sector surviving as a whole. So everybody getting some level of education in the products they are exposed to or are exposed to them is critical to the sustenance and viability of the financial systems or the financial system. But as banks, we also have a duty. And you've seen in just recent past, a bank has advertised a new product that is going and targeting women business leaders at a rate significantly below market rate. 10% is what I heard. There are also issues around risk management that as banks need to take on board. We need to also be able to drive our own positive stories. We've stayed a bit behind the stories, and sometimes we are left chasing the narrative. Banks are doing a lot in our communities. And when we talk about ESG, corporate social responsibility, and all these things that banks do, we need to create a platform that enables banks to highlight their interventions in the communities where we do business. We've talked about strengthening of governance and also staying very close to the customer. And it's critical that in these difficult times, customers are kept within our ranks and they are fed with the right information before things get out of hand within the public space and social media. Again, our development partners, and Robert, from the survey, you are asking people to say that which is the most important. And that is why perhaps the development partners, you didn't have people voting because of the other contestants in that survey. But they are very critical in these times. And whatever interventions that they do, they must have the banking system as a cornerstone, because it is this industry that will anchor any form of economic recovery post-IMF. And finally, I would like to talk to our media practitioners. Sometimes we find banking stories as one of those social media stories, and then we throw things out in the air, but people act on these stories. So if we are not sure, we should reach out, talk to us at Ghana Association of Banks. We are ever ready to talk to the media, explain, so that you don't draw conclusions that will unnecessarily heighten confusion within the banking system, and potentially people may act on it, and it can have a snowballing effect. It's a country we are building together. We should all come together and say, this is our country. What do we do? In these times, what can we also do to support the banking industry? Not just the bank, the insurance industry, the securities industry, we have the pensioners industry. There's so much within the financial services sector that we all together have to build. That is what will anchor any form of growth. And finally, to our customers, we thank you for your business. We thank you for your custom. We'll continue to stay very close to you. And please feel free, go about your business, talk to your banks. Your banks are ready to help you drive your business and your household. Robert, thank you and your team. And Mr. President, thank you for the opportunity.
Thank you so much, John, for identifying the key stakeholders and what we must all do to collectively build a stronger country, certainly a stronger sector called the financial sector, certainly stronger banks, regulators, practitioners. Certainly our case is clear as an issue. Document the case studies and the lessons for education, media, judiciary, and so many more. Thank you very much. I think what we are taking from this, or I'm taking from this particular event, is our next thought leadership. And it seemed to me that you have given us the topic, which is credit culture in the ecosystem, the character of the Ghanaian. It sounds an interesting topic, and I can bet all of you will make great panelists. So please, let's look forward to the next thought leadership event from the Chartered Institute of Bankers. Let me also quickly mention that next week we have operational risk management in banks, which is a training that we should attend. The Institute is leading that training. But it's also clear that we have to do more in driving the mandate that we have as an institute, and we are determined to do that to remain relevant. On behalf of the Governing Council of Chartered Institute of Bankers Ghana, I'd like to say a big thank you to our panelists for sure, and certainly our audience. I'm glad to say that we've had close to 250 people on this call consistently, and even as we are speaking, we have about 220 still with us. It shows the level of interest in not just the sector, but also the need for us to sustain confidence. And that, I think the message is very clear. The polls kind of point us to what the perception is out there. Our aspiration is to document some of the insights that you've shared with us and circulate same to our stakeholders. So once again, from Tony to John to Dr. Amoah, and certainly Professor Noel Tagoe, we are extremely grateful. To Mr. President of the Chartered Institute of Bankers Ghana, thank you so much for your leadership, and to the council, thank you. To the staff colleagues here, we are extremely grateful. Let's have a great day and good afternoon to all of you. Thank you for spending extra 20 minutes or so, 18 minutes with us to be precise. Have a fantastic day. Thank you.
Thank you very much, and all the best.
Thank you. Thank you, Robert.
Thank you.